Good evening, everyone, and welcome. A big thank you to everybody that's joining us this evening to be part of what should be another excellent financial wellbeing webinar. My name's Steve Ardestate, and I work at Rubberley Cares in the role of Wellbeing Projects Manager. We take great pride in practicing a preventative and a developmental approach to wellbeing at the charity, with the aim of empowering people with the necessary skills and tools in order for them to have the ability to take care of whatever aspect of their well-being is in focus. With this in mind, we're really optimistic about tonight's webinar being hosted by our long-term partners, Mattioli Woods. Mattioli Woods continue to provide an incredible service of support, which is game-wide. So without further ado, I'll hand over to our experts this evening, Adrian and Mark.
Thanks very much, Steve. That's a pretty big intro. I better make this interesting over the next 30 minutes or so. But thank you very much for the introduction and welcome, everybody. Thanks for joining us. Obviously, people are just rolling in now at 6:32, so it's great to see you all as you're arriving. This is the second of our evening webinars. I think it's starting to become a bit of a habit that we put these on every now and again. And we hope that by delivering these webinars that we're looking at things that are topical, things that are in the news or things that might be affecting us and our finances. Financial well-being is a really important part of a player or a person's overall well-being. We tend to look at three main categories in supporting people, their mental fitness, their physical fitness, and their financial fitness. And those things all fit together hand in hand. And that's why we're trying something different. We're putting on some evening webinars off season where people can join us. We'll talk about topical stuff and you can ask questions of us. Before I go on, I just want to make really clear that any information that we're speaking about and presenting about tonight relates to the 2023-24 tax year. So it could be a little bit dated by the middle of next year after we've had budgets and new tax years, etc. And also, we're not here to give any financial advice whatsoever. The idea of the sessions is that we impart some of our knowledge and we learn a little bit from it. And hopefully we can take that into our personal finances and put some of that into action to try and help ourselves. So I don't want to give people 3,000 things to do as a result of the webinar, but I hope on the way through that we might find one or two things that are of interest on the way through, which you could do with your own money and with your finances, and hopefully that would make you a little bit stronger. As we know from player welfare surveys that are carried out every year, finances always comes very high up on the list of support that players ask for. So we will keep talking to as many groups as possible as the seasons tick by to try to get people to take their financial well-being a little bit more seriously. And as Steve's alluded to already, I'm not on my own here tonight. So obviously I have Steve in the background, but I also have my colleague Mark Redmond in the background as well. Mark's job primarily is to, take over if something goes wrong, which I hope it doesn't, but primarily is to answer your questions and open up a conversation with you. So on the right-hand side of your screen, you'll see a section that in the white section that says Q&A. Click on Q&A and there'll be a text box underneath. If you type in that text box any questions that you've got, Mark will pick those up and he will respond back to you. Can I just say in the Q&A section, if you type something in, it's in private and it's in confidence. So nobody else in the audience on the webinar will be able to see what you're typing, and Mark's response will only come back to you. So again, I just want to reiterate the fact it's in private and in confidence. If a really complicated question comes up and we don't have time to answer it during the webinar, we need to go away and do some research and look stuff up for you. We've got your email address and we will send you a response through tomorrow. So after the webinar finishes, we have your email addresses and we can come back to you if we need to. Which brings me on to another bit, which is now a new legal bit for us, which is our GDPR statement. I just want to confirm that we're not going to use your email address for any other purpose other than responding to questions if we don't have time during the webinar. After the webinar's finished, we're going to delete everything. We don't keep them for marketing purposes. We don't sell data on to third parties, so it's private and it's secure. and it's just between us on the webinar tonight. So Mark doesn't have anything else to do this evening other than answer your questions. So you better put something in there and keep him occupied on the way through, because he already knows what I'm going to talk about tonight because he wrote most of this presentation. So we are going to be looking at the topic of saving and investing tonight. We're going to be building on some of the information that we covered in our previous webinar, but perhaps taking it one step further. And before I start, I want to make crystal clear that saving is not the same thing as investing. They are two completely different subjects, and I'll try and help you understand the differences between the two as we go on through the webinar. But before I start, I think bearing in mind the current economy and the situation that we find ourselves in, we're heading into another winter 23-24 with high energy prices and pressures on our personal finances. There is one thing in the background which is also going to be affecting us over this winter period, and that's interest rates. So I thought before we start, we should just have a very quick look at interest rates, where they're at now, and what that effect might be on us. So in order to start at the very, very basics, first of all, we have in the United Kingdom a central bank, and it's called the Bank of England. And that bank sets interest rates for our economy. It sets what's known as a base rate. Now, that base rate is then used by financial institutions to work out their profits and their losses. So, in effect, they're setting a bar from which, okay, if you were borrowing, it might be slightly higher. If they were trying to attract savers, they may give you a rate around that mark or slightly below it, so they make a cut. But that base rate sets the cost of all the financial services products that we buy on a regular basis. Now, if you're a saver, well, it's been good news, because over the last year or so, interest rates have steadily been rising to where they are now, which is 5.25% as a base rate. So this means when we're putting money into the bank, if we look around for the best rates that we could get, we should be getting around 5% for holding money in the bank. And that's interesting, because if we're looking at investments and making investments, well, those investments have got to outperform 5%, because we can put money in the bank at 5% interest and not take any risk at all. We can hold cash. So it's a really interesting situation compared to the last 10 years or so, which you can see from the diagram there. We've been struggling to break 1% interest. It's been very stagnant around 0.25 to 0.5% as a base rate. The Bank of England have pretty much had very little to do over that period of time, but inflation has been the main driver for increasing those rates. So it's seen as good news if we're a saver, because we can attract more interest on our money. But of course, the flip side of the coin is that it's seen as bad news if we're a borrower, and most of us are borrowers. We have mortgages, credit cards, loans, overdraft facilities, all those kinds of things. And that is where we see the cost of borrowing is going up and up and up. So let's just take an example of a £130,000 mortgage that you want to pay off over 25 years. We are using your ordinary grey standard mortgage to do this. If the interest rate was 2.5% on the mortgage, then on 130,000, we'd roughly be paying about £585 a month. If that interest rate on the 130,000 rises by just 1% from the Bank of England, that £585 a month becomes £682 a month. So it's £100 more expensive per 1 percentage point, if you like, on 130,000. Now, if you've got 260,000, you can double those figures. And by thinking about that example, you can see where mortgages are going to be very, very expensive for people to renew them. Now, we're not going to be talking about mortgages or second properties or buy-to-let properties tonight. And we will come back and look at that in a bit more detail in one of our future webinars in a couple of months' time, if we put another one on. We are, though, tonight just looking at the normal standard savings and investments that people want to make as part of their normal financial planning. But if I could make a very quick point on this, which I'll probably reiterate in a couple of months' time when we look at this again. If you have a mortgage that's coming up for a renewal because it's been on a fixed rate over the last 2 or 3 or 4 years, you need to start preparing for the high interest rates that you can see there in that chart 6 months before the end of your deal. So what we're effectively going to do is we're going to get a new mortgage offer 6 months in advance, and most mortgage offers last for 6 months. So if we're not going to use it, we're just going to bank it. That's our mortgage offer, and we know we've got to renew in 6 months' time. If the Bank of England increase rates any further, well, we know we got the best deal that we could possibly have. But if the Bank of England reduce rates during that 6-month period, well, we just get rid of that mortgage offer and we organise a new one at a lower rate, right up to the point where we come to the end of that fixed rate deal. If there are any young people on here who are saving up for the first mortgage, you've got no idea what I'm talking about, don't worry. We'll come back and have a look at it in another 6 to 8 weeks' time when we do another webinar. And that's one of the things that we'll probably have a look at that point. So economically, rising interest rates, good news for savers, bad news for borrowers. We're not going to be looking at borrowing tonight, but we are going to be looking at saving. And I just want to start off by making it crystal clear that savings are completely different to investments. Savings are the cash, the money that we put into the bank. There's no risk. There's only a little bit of interest paid on that money. And hopefully by continually paying in, we can get our savings to grow. We use that for our short-term financial planning. Investments, which we're going to come and look at a little bit later on, investments are very much for our medium-term and long-term financial planning. So we'll loop back and have a look at those in a short while. I'm always reminded when we get to this slide of a quote from a lady called Sophia Amoruso. Nobody will know her, but she was one of the founders of Boohoo, the online fashion giant. And she was very wisely quoted as saying that money looks better in the bank than it does on your feet. And she was in the fashion business as well. And that's really what we're talking about. So when we've done our webinar, the past webinar, the one we did previously and this one, we are really interested in people getting to grips with looking after their finances, not just looking after them, but starting a plan. And the plan is to have a short term, a medium term, and a long term financial plan. Now, in the current economy and the winter that we're facing, and remember in the last webinar we looked at the increases in the cost of living. Really, there's not much that we can do about our short-term financial planning. We just have to be prepared for it, because we've all got Christmases, birthdays, holiday periods, and all those kinds of things to pay for. So there's not much we can do about it, but we do need to have one eye on it to make sure we've got enough money to pay for it. There's also not much we can do about our long-term financial planning. We do look at things like pensions and being a member of a pension scheme to do that. That's the main reason why we have automatic enrollment in the UK, is to make people save for their own retirement. But the medium term stuff, we can do things about that house move, maybe starting a family, maybe changing a medium car for a very expensive car, those medium term plans. We can shift those backwards and forwards. And that's where I think at the moment, with the winter and the high costs that we're facing, we can move those things either backwards or forwards. If we're flush, we can move them forwards. If we're running out of money, we can move those things back. But we must concentrate on making sure that we meet our short-term financial commitments and we have one eye on our long-term financial commitments and continue to save towards looking after ourselves in later life, because nobody else is going to look after us, certainly not the state. So it's up to you. One of the things that we looked at in the first webinar was setting ourselves up with a budget. We've already covered this, but if you haven't done this already, it's the number one priority for anybody who wants to manage their finances. And it doesn't matter who you are or how much money you earn. If you don't have a regular budget that you try to stick to, then you're going to be out of control with your finances. You're going to get to the end of the month and worry about why you haven't got any money left. Well, a budget's going to tell you where it all went to and how you could change that the following month. For the older people on here, like me, it's an Excel spreadsheet. It's one column's money in, one column is money out, and we try and balance that up. For the younger ones on the webinar, there's a smart app to do all this. There's actually loads of smart apps to do all this. Just do bear in mind, if you're going to use a budgeting app, that the ones that are free are the ones that tend to sell your data in order to make money, whereas the ones that you pay for tend to not sell your data on to third parties and other organizations because they're charging a fee and making a profit from offering their services. But anyway, that's just a quick reminder on the apps. This budget that we got up there on screen, we set it in the last webinar. There's £400 for socializing on there. I'm not sure whether you think you can, you never spend 400 quid on socializing, or whether you can get through that in one weekend. Either way, we do need to make sure that we enjoy ourselves with our money, because we play rugby or we come to work to earn money to go away and enjoy ourselves with the fruits of our labor. So we do need to have that built in. So when we're talking about saving, we've reached a point here where I'd like to launch a poll. So you should have a question on screen. And the question is, do you have an emergency fund? Now, as you're answering this, it's not borrowing, so it's not a credit card in your wallet or your purse. This is a money set aside, an amount of money set aside just to cover eventualities. The car breaks down, you need to get it fixed. The washing machine breaks, you need to buy a new one. If you could pop your votes on screen for me. Some of you will already suss this out, but I have to pad for about 20 seconds while all the results of the poll come through to me, and then I can comment on what people have voted on. At the moment, we're a bit 50-50-ish. I'm just going to give it 5 more seconds while it's so slow when it filters through to me. Okay, I'm going to call a line there. 2/3 do have an emergency fund. Fantastic. It's a really good financial discipline to have. 1/3 of us don't have an emergency fund. So again, when I was talking at the beginning about only finding 1 or 2 jobs for you to do, for those that don't, you might want to think about starting the savings journey after the webinar, after Christmas is out of the way, but setting yourself a New Year's resolution to have a look at it. Thanks for voting, everybody. I'll just cancel that off. Well, listen, starting a savings journey or improving your savings journey is really easy to do, but it does start with that budget. And once we know the money we've got coming in and the amount of expenditure that we have to spend out on each month, then we'll have an amount of money left over that will allow us to go out socializing and, get some new clothes every now and again, buy presents for people in this holiday period that we're heading into. But it also will give us the opportunity to put some money into the bank. Now, we've got some figures on screen which are a little bit out of date, I think, because 1%, 2%, 3% growth is highlighting the fact that you should be shopping around for the best interest rate when we're putting money in the bank. It goes without saying, it's a fairly straightforward thing to look at. But I actually think you could achieve at the moment somewhere nearer to 5%. But we are looking at a 5-year period. And if you remember the slide from the Bank of England at the beginning, well, their projections over the next 5 years for interest rates is that they would be back down below 2% by that mark. So I guess we're not that far out of date with an average interest rate over a 5-year period. But look, it really can grow really quickly, and it's not much more than a posh cup of coffee a day that we might want to be put into one side. If you remember in the first webinar, I said being, wealthy and looking after money is not saving £1,000 here and £10,000 there. It literally is the £5 here and the £10 there that adds up to a large amount of money over the course of your financial year that you're working to. And if we're trying to, you know, get more into our, get more money into our accounts, then it really is the fiver and the tenner here that we need to look at. Just one other thing which might not have occurred to you. We've covered this slide before. We did it in our last webinar. I will quickly recap it in a second. But the reason why we need to be very keen on individual savings accounts or ISAs at the moment is because we have something called the savings interest allowance, which everybody, unless you're a 45% taxpayer, which is the super high rate taxpayer, everybody in the UK has a savings interest allowance. Now that allows you, if you are a 20% taxpayer, to earn £1,000 interest during the year before you start paying tax on the interest that you're earning. If you're a 40% taxpayer, you have an allowance of £500 a year of interest on your savings, but after that, you start to pay tax on the interest that you're earning. Now, if you remember the chart from the first slide, that line was flat and below 1% for 10 years or more. Was never an issue back then. Now, at 5% interest on our money in the bank, it is an issue. If you're a basic rate taxpayer at 20% and you have £20,000 in the bank and you're earning 5% on your money, that's pretty much going to use up all of your savings interest allowance. And you'll find yourself having to pay tax on interest that you earn over and above that mark. If you're a 40% taxpayer, it's slightly worse news. If you have £10,000 in the bank and you're earning 5% interest, well, there's your £500 allowance gone. Anything over and above that, and you're starting to pay tax on the interest. Now, let me remind you, you got paid and you had tax deducted and national insurance deducted. They gave you the money. And then if you put that money in the bank and you're over your savings allowance, you're then also paying tax on that money over and above. We want to avoid that. And the number one way of avoiding that is to use individual savings accounts. Now, I'm going to come back and look at stocks and shares ISAs a little bit later on because we're going to talk about investments. But cash ISAs, if you're starting the savings journey or if you want to improve your savings journey, then shielding it away from paying unnecessary taxes is the way to go. We have an annual allowance for ISAs, which is £20,000 a year. Everybody can pay £20,000 into one, two, or three types of ISAs. And remember, in the budget, the Chancellor announced that we could actually open 3 different accounts for these things next tax year. At the moment, it is one ISA account per person per year. But nevertheless, you could have a lifetime ISA within that, known as a LISA, stocks and shares ISA, and cash ISA. And you can move money around within the ISA. We are going to be using the cash ISA to make sure we don't pay tax on our interest that we're earning. And cash ISA rates are running at around 5% at the moment. So you should very easily be able to find one that'll do that. You can pay up to £20,000 in, and the money is protected through the Financial Services Compensation Scheme, which is an insurance policy in the financial services industry. Should anything happen to your bank, building society, or financial institution that you're using, all of them are protected. The only thing with this is just to make sure that you're not with 2 different brands that are part of the same banking organization, because you don't get 2 lots of cover. You only get 1 lot of cover. So it's per UK banking license. My example on this is usually First Direct and HSBC. They are both owned by the Hong Kong Shanghai Banking Corporation, operating under 1 license. So if you've got 85,000 with First Direct and 85,000 with HSBC, you don't get 2 lots of cover. But if you had 85,000 with Barclays and 85,000 with HSBC, you do get 2 lots of cover. It's just a thing, just a joke with the insurance policy, but it's worth bearing in mind. I do want to mention lifetime ISAs very quickly, because if you're looking to save up for a property, well, you can use this to save up for a deposit. But not just that, if you're under the age of 40, but you've already bought a first property, you can use lifetime ISAs to save up for income later in life. And the bonus on the 4,000 maximum that you're allowed to pay in is 25%. You did hear me right. It is 25% on it. Now, for those of us who are smidgen over the age of 40, we might have older children aged between 18 and 40, and they can open a lifetime ISA, and we can gift them money to put into that lifetime ISA, in the vain hope that they might actually leave home in the near future and go off and spend their own money somewhere else. Anyway, moving on. I don't want to spend much more time on saving because I think we've covered the main points on the way through. What I do just want to very quickly mention is we might be a beneficiary of a lump sum at some point in the near future. We may be a beneficiary of a will, or our 6 numbers might come up on the lottery, whichever happens. And this is just a long-term effect of putting money away. I do want to underline the point that if we're averaging out interest rates over a long period of time, like 15 years, well, we start to lose out against the Bank of England base rate and the rate of inflation. So that's where our medium term and long term financial goals come into play. Is what are we planning for, and are we putting our money away with enough time to make a decent profit on them? And for that reason, some people are interested in risking their money a little to try and get a better rate of return. Now, before I talk about investing, I do want to introduce the topic of risk. And some of you may be sitting there going, why on earth would I risk my hard-earned money in order to potentially lose it all? Well, the flip side of the coin is that we might be losing out by holding money in cash in the bank against inflation. Look at inflation in a minute, but there are various degrees of risk. Now, cash is low risk, and that's what we've been talking about so far. So putting money into the bank, you are guaranteed to receive that money back at least, plus we would hope, a rate of interest paid on top of it. There are lower risk investments, such as things like gilts and bonds. Bonds are issued by companies, gilts are issued by the government, which is government borrowing. And they have a fixed lifetime and a fixed payout at the end, but they are tradable assets, so you can release them early if you want to. But those are seen as relatively low risk because they have a finite value on the end of them. Property is obviously very, very popular with rugby league players, not just buying their own main property, then purchasing a buy to let or moving on up the housing market and keeping their older property buy to let. In the investment world, we can invest in property, but it tends to be commercial property because commercial properties can be put into investment trusts, and those investment trusts pay dividends out, have shares usually listed on the London stock market for property trusts, but they're seen as lower risk than equities, which is a step up in risk again, which are things like stocks and shares and buying shares in companies and trading in them. So those are the relative levels of risk with any investments. And whenever you are making an investment, you should see whether something is low risk, medium risk, high risk, etc. And there should be lots of health warnings that come with them, that you might not get back what you've paid into them, and you may get back less than your initial investment. You'll see those kinds of small print all over those kinds of products. Well, listen, let's get on with our second topic of the evening, which is investing. And there's a very, very famous American investor. I don't know if you've heard of him, but his name is Warren Buffett. He is one of America's richest men, a multi-billionaire, started from nothing, a very wise old gentleman. And he quite simply says that investing is laying out money now to get more money back in the future. And I want to underline his quote a little bit because we are, with investments, talking about our long term financial future. So, medium term to long term. We're not going to mess around with short term stuff, and we're not going to be millionaires this time next year. But if we make some smart investments in the next 10 years, 15 years, 20 years, we may well make a nice, tidy profit out of them. But can I underline the point? We may also lose money on those investments as well. That's the risk element. Before I go on and look at investing any further, I do want to look at the topic of inflation, because this is one of the drivers between saving and between making investments. And inflation is always a moving beast. The October 2023 inflation figures, which you may have seen the government saying how wonderful they're doing in managing the economy. Well, actually, it was just reining in the cost of living rises that were plaguing us over the last 12 months. But that inflationary figure for October 23 was 6.5%. So keep that in mind. Just run you through a quick example of the practicalities of inflation and how it might affect us. If I have a £20 note now in my wallet, or you may have one in your purse, you can go out today and buy £20 worth of goods and services. You can probably do that tomorrow as well. You can go out and spend your £20 and get value out of it. If we were to do that in 12 months' time, I don't think your £20 is going to go as far as it does today. And that's what inflation does, which is make things more expensive. So you may think, well, okay, all right, I've got this £20. I want to make sure that I can spend it in 12 months' time, but I need to be earning on it. So I pop it in the bank. And if you're not shopping around for the best rate, you might get 2% interest on your money if you're just really lazy and stick it in an old account that you've had for the last couple of years. Well, that means that next year you'll have £20, and a simple interest calculation is £20 and 20 pence. So you've earned £20 on your 20 quid. Now, remember, inflation was running at 6.5% in October for the 12-month period up to October 23. And that means that you need to have £21.30 this time next year to keep up with the rate of inflation. You only had £20 and 20p. So you've lost nearly, just over £1. Now, you've lost £1 on 20 quid. If you multiply that up by the hundreds, if not thousands of pounds that people are holding in savings, now you can see why you're losing out to the rate of inflation. So you think, okay, then, in order to try and keep up, I could make an investment and I could try and keep up that way, because investments move more than money that I'm holding in the bank. And this is probably a good time to actually talk about what investments actually are. I make no apologies from starting from the dummies guide at the very beginning, and then we'll work up from there on investing. Think of all the biggest companies you could possibly think of. When I think of big companies, I look around me. I think Apple, because I've got a phone here. I think of Vodafone, because that's the network that I'm on. I think of companies like GlaxoSmithKline, who made the vaccines that helped us through the COVID period. I am not telling you to go out and buy those companies. It's not financial advice in any way. But those companies are owned by the shareholders. So you can go out and you can buy a share in that company, and you can hold that share, and you actually physically own part of that company with that share that you have. Now, when you've got that share, being an owner, if they make profits, you're entitled to a share of those profits. It's called a dividend, and they're paid out to shareholders usually twice a year, once a year after annual announcements of reports and accounts, and at the half year stage, and you receive a share of that profit. Don't forget that, because a lot of people just go, I'm going to buy a share and then I'm going to sell it when it goes up and I'm going to make a profit. Basic rules of stockbroking: buy low, sell high. But you also do receive dividends, which is another way to make money from owning a share. Now, you can own lots of shares. You can buy a share in any of the companies that I've mentioned already, and you can hold them, and you can then sell them at some point in the future and make a profit on them. In the meantime, you've been banking dividends on them, which is making a profit, and in exchange for any interest that you might have held for holding it in cash. But it starts to get quite complicated. And I think if you were just buying one share and holding one company's shares, then you're kind of holding all your eggs in one basket, because if that one company does well, then great. But if that one company doesn't do so well, you've lost money on it. So for that reason, we might want to look at investing in a group or a batch of shares, if you like. And this is where we create things called funds. Now, those funds will have a purpose to them. I'll give you an example. A FTSE 100 fund would be you investing in a mix of shares that are taken from the 100 largest companies in the United Kingdom that are listed on the London stock market. Now, obviously, you wouldn't just buy one company's shares one month when you were paying into it and another company's shares another month. You would buy units that are made up of all of those 100 companies' shares. Now, when we look at funds, it allows us to diversify the risk. Some of those 100 companies will do really, really well. A couple of them might not. They might have reduced profits. They might not pay a dividend one year. So those the kind of things that might affect the share price. Also, general markets might affect the share price. But essentially, we're looking for profitable companies that do well and that rise in value over time. And again, can I remind you with investments, we're not looking at this time next year. We're looking at the next 5 years, 10 years, 15 years down the line. And when you look at diversifying your holdings using funds, well, it's seen as a good thing because we're slightly mitigating some of the risk. Now, with funds, there are literally thousands of funds to choose from. Within the financial services industry, we are supposed to peg them using 9 different levels, 9 being the very highest risk, 1 being very low risk, and all levels in between. But perhaps if we're middle of the road, we are looking for a 4 or a 5 or a 6, somewhere around those grounds. Within a stocks and shares ISA, you'll find lots of funds to choose from. All funds, everybody, all people who work in financial services, and all of those funds are all regulated by the Financial Conduct Authority. If you're talking to somebody about making investments, they should be listed on the FCA register. I'll tell you all about it in a short while. But all professionals, anybody who works, are all on the FCA's website. And literally, when you go on the FCA's website, that register is very clear and easy to find. And it means that you can look anything up that you're interested in very quickly, making sure people are who they say they are. Now, I said I was going to talk about stocks and shares ISAs again. This is where I come back to that because within a stocks and shares ISA, we can make investments and buy into the funds. Lots of ISA providers, lots of funds for you to choose from. Literally, whatever floats your boat, you will be able to find it. Remember the limit on all ISAs is £20,000 a year. And so maybe we could do the majority of our money in a cash ISA, but within that ISA account, we might be able to take a little bit of that money and maybe put it into a stocks and shares ISA and buy into a fund or a group of shares for us to invest in. The main reason for using an ISA for our investments is to make sure, again, that we shield them away from tax. Now, with investments, this would be called capital gains tax. A capital gain is the difference between what we bought an investment for and what we sold the investment for. And if we go over our annual limit, we're quite simply going to be taxed by the taxman. So if we use a stocks and shares section of our ISA, then we can protect it from the taxman. He can't have any of those profits. Remember, you earned money, you paid tax on it. You don't want to pay him more tax again. So that's the reason why we can shelter them in that stocks and shares ISA. Now, if you're looking at stocks and shares ISAs, you have to choose an investment for it to go into. And this is now the time where you can decide what kind of an investor you want to be. I'm not telling you what kind of investor to be. I just think it's really important to think about it. Remember, we talked about property earlier on. Lots of rugby league players are really interested in property for some reason. Well, you can invest in property, but that would be commercial property, as I mentioned. It would be in something called a real estate investment trust or a property trust, and you would be able to invest in those. You can actually invest in money markets in cash on global markets and have traders through a fund help you with making money there. A couple of things I want to highlight really are ethical investments because they are growing in popularity. And the reason for that is that you can, as an investor, decide actually, I'd like to steer clear of oil and gas. I'd like to steer clear of tobacco products. I want to steer clear of plastics production. And you can do that with various funds that'll be on offer to you to choose from. And they will be labeled as green funds. And also, we do have a lot of people who have investment needs that are to do with their religious beliefs. And again, there are lots and lots of funds that are compliant with various different religious beliefs. So again, go on, have a look. Really, the world is your oyster. And lastly, I was talking to somebody a couple of days ago about gold. Again, you'll find a gold trust. So if you want something sparkly and Christmassy to go in your investments, you will find a trust that deals with that as well. Now, with investments comes risk, and no greater risk than losing all of your money. Now, I fully appreciate within rugby league that there is, and I mean, nothing by it, but there is a little bit of a herd mentality as far as someone in a team saying this is a great thing to do, and everybody else going, okay, great, I'll follow them and I'll do that with them. Don't follow the herd mentality in any way. Make your own choices about how you invest money. And if you go online and stick into any kind of generic search engine, I'm not allowed to recommend products and services, but if you Google, investing, you'll immediately be hit by a bunch of online trading platforms, which will want to attract you to get you to use their trading platforms. And what you're doing there is you're not making an investment; you're entering into the world of day trading. If you go on YouTube and have a look at it, I'm sure you'll find lots of people who want to show off with their fancy cars, big houses, and islands and aeroplanes. And they do about an hour's work in the morning placing trades for the day, and they tell you they earn millions of pounds or dollars every year doing that. And I just want to underline the fact that that is not true. It is hugely misleading. The UK's largest trading platform is eToro. If you go on eToro, they will make it abundantly clear, whilst you're in the enrollment process, that 74% of trades that are placed on their platform lose money. Also, 70% of people who open a trading account lose all their money within the first 12 months. Now, those are long odds, and day trading is for professionals, it's for professional brokers, fund managers, hedge fund managers. That is their full-time permanent job, 12 hours a day, pretty much 7 days a week. We're not going to be able to amass enough knowledge, I certainly can't, in order to make a day trade or make day trading work for me. So do avoid those. And also there's a danger with things like cryptocurrencies as well. They're very dangerous. They're very volatile. They go up and down like a fiddler's elbow on a daily basis. And I don't know about you, but if I make an investment in a gilt, that is a government bond issued to raise currency for the government to invest in. Well, if I'm buying a cryptocurrency, that's very different because there is no government behind it. There's no economy. There's no people paying taxes to support that economy. So cryptocurrencies are based on the blockchain, which is the mining of that currency. And I personally don't have the confidence in understanding how that works. So therefore, why would I invest in something I've got no idea how it works? Lastly, quick point on cryptocurrencies. They only exist for illegal activities. They're used for money laundering, purchases on the dark web, those kinds of things. So, best steer clear of them, I think. Do watch out for scams and frauds. Anybody who says they can liberate your pension schemes, they're lying. You can't liberate any of your pensions until you reach the age of 55, soon to become age 57 in the year 2028. And do watch out for people who pressurize you into making investments as well. There are no deadlines or high pressure sales tactics allowed in financial services anymore whatsoever. So undoubtedly it's a scam or a fraud that you've been offered. If somebody's telling you that it's of a limited time or you've got to make a decision straight away, you don't. Because it's complex and because it can get fairly complicated, people usually rely on financial advisors in order to help them to choose their investments and make those investments and look after them for them and review them on a regular basis, because there's no point in regularly putting money into something that we want back in 10, 15, 20 years time if we don't review it every year to see how it's doing and form a picture of whether that's a good investment for us. I do, just very quickly with the time I've got left, want to let you know there are two types of investors, that two types of advisors, my apologies, that you're going to come across. There are independent financial advisors, does exactly what it says on the tin. They're independent, so they can look at the whole of market and make recommendations to you as to what they think might be a good investment. You might also come across somebody called a restricted advisor. Now, the word restricted is negative, but it shouldn't be negative in any way. Restricted advisors are experts in one particular area, so therefore they restrict themselves to being specialists at one thing. I just give you a quick example. If you see a restricted pensions financial advisor, they are a specialist in pensions. They are not going to sell you a mortgage or a credit card or anything else, because they simply don't know or are not authorized to sell those products, because they've been designated as an expert in that area. So don't be put off by the word restricted. It probably means that you're talking to an expert in that particular field that you might be coming across. And do also check the FCA website. Sorry, that was just on the previous slide. Literally, you can go on the FCA's website. You can do it right now on your phone. You can input my name, Adrian Firth. It's probably wise for me to tell you my first name legally is actually Russell. Nobody's ever called me Russell. But if you put in Adrian Firth, you will also find people who are known as Adrian Firth, but he's on the register as Russell Adrian Firth. You can see me there. You can see what I'm regulated to do and not to do. Literally, with 30 seconds, you can look up anybody and find out if they are who they say they are. So just protect yourself away from people who are not who they say they are or selling something they shouldn't be. Interesting, actually, on the FCA's website, which is listed there on this slide, you can also find out about scams and frauds that are taking place in the UK at the moment, because they publish them when they find them, so you can keep up to date with scams and frauds. Listen, some good places that I go to for information on advisors, unbiased.co.uk, find advisor.org, and Vouched For. All of those have people that work in the financial services industry that are regulated to do so, but also have user comments back. So people who've used them, whether they thought they were good or not. So you can go on there and have a look. I always mention the moneysavingexpert.com on all of my webinars. You know, it's Martin Lewis's website. If you want to look up some of this information that I've been talking about tonight, get on there, moneysavingexpert.com. Tons of useful information on there about saving and about rates that you can get, and what products are the best rates in the market. Vice versa. Also, there's a lot of information on there on investments, making investments, keeping an eye on them to see how they're doing as well. So bringing it back to the purpose of all of these webinars, and I'm not going to recap what we've been through because you just heard me talk about it, but the purpose of the webinars is to get us to think about our finances more than we were doing previously, maybe to pick up one or two little hints and tips on the way through. If I've hit on anything on the way through, you think, yeah, he's right, I probably could do that a little bit better, well, great. But please do take some time to consider your short term, your medium term, and your long-term financial goals, so that we can just commit a little bit of time and effort to each one to make sure we're heading in the right direction with our finances. But do remember, in this season that's upon us of holidaying and making merry, to do enjoy the short term as we get to it. Now, on the way through, Mark's been quietly and diligently in the background. I've seen the red dots going to and fro on my screen, so I think there have been a few questions. Mark, if you're there, do you want to pop back on?
Yes, I'm here.
Hiya, you're right.
Evening. Yeah, I'm absolutely great. Thank you very much. So, a real mix. Been pretty steady evening, to be fair. Yeah, after a long day, I know that, and you're coming across this. But a couple of interesting points. The budgeting apps that you mentioned earlier. Yeah, I don't know. Quite a few have disappeared over the last few months, basically because they weren't making any money.
Yeah.
But there are still some good ones out there. So there's Emma's a handy one. There's a thing called Hyperjar, which is an interesting one. It's a bit like Granny's old old jar where you had slots for the gas and the coal and all this sort of stuff. But there are still budgeting apps out there, or you might have a slightly more modern account, something like Monzo or something like that. They've got budgeting apps built in, but do use them. They're brilliant. The other stuff, lifetime ISAs obviously gelled a little bit of interest, as we'd expect. Adrian was telling you the truth. 25% bonus, and that bonus, let's say you put in £100 one month, the bonus appears the following month. So it's not that long before you've got a bonus of, in that case, £25, and you're earning interest. For what it's worth, yes, you can get a lifetime ISA paying quite a decent interest rate of just over 4%. And there's an outfit, well, Money Saving Expert, Adrian's gone on, explained we do use that one a lot ourselves. And there's another outfit called Money Facts. So that's Money and Facts, FACTS, all together. And they publish best buy tables as well. Quite frankly, if you stick to Money Saving Expert, you'll find them all anyway. That's it, I think, from that end. But do, take advantage of whatever is out there, because quite frankly, at the moment, it's as tough as it was 6 months ago. So good luck.
Yeah, it is. But hopefully we've covered the economy and the current situation. Thanks very much, Mark. I really appreciate you looking after the questions and comments that people have been raising in the background. They're all fairly common with we run this session for our corporate clients as well as for Rugby League Cares and other organizations. And yeah, the similar topics do come up. So you're all absolutely bang on in picking up on some of those things that I've spoken about on the way through. Well, listen, we are at the end of the session. I've not kept you for the full hour because I'm conscious we're in an evening. People want to grab a meal. People want to spend time with their families and things like that. My email address has been on screen here for quite a while now. You must have had the opportunity to at least take a photo of it or scribble it down on a piece of paper. But after the webinar this evening, if you want any help or any assistance, we assist Rugby League Cares on a not-for-profit basis. We don't sell products. We don't sell services. We just offer our insight to staff and professional rugby league players. So just hit us up with any questions that you've got, and we will reply back to you as quickly as we possibly can do. But other than that, I don't think Steve wanted to come back on. So without further ado, I will wish you a very pleasant evening. And I really look forward to being able to talk to you again in 2024, when hopefully we'll carry on with our evening webinar sessions. But other than that, bye for now and see you again soon.